Hey guys, so today we're going to be diving into a very popular ETF matchup. That's SCHD and VIG. Both are very incredible dividend growth ETFs, but they each serve a slightly different purpose. So in this special versus episode of Diamond Dividends, we're going to break down both ETFs using the same 5 metrics that we normally use on a Diamond Dividends episode and figure out which ETF will work best for you when it comes to dividend and share price growth, especially as a low budget investor. So let's start with SCHD. SCHD is your Schwab US Dividend Equity ETF. It tracks the Dow Jones US Dividend 100, which is a series of companies that have a high dividend yield and good financial health. That's based off different health screens to determine quality, including return on equity, the ratio of debt to free cash flow, dividend yield, stuff like that. This ETF also has about $75 billion in asset under management and about 103 holdings, which just lets you know how diverse it is, which is what you're looking for with all ETFs. When it comes to its holdings, you'll see it leads off with energy at 19.54%, followed by consumer defensive and healthcare at 18.96 and 15.89% respectively. That consumer defensive should indicate recovery and not much volatility when bad things happen, especially when tech takes a deep dive, which is important because tech is typically the most volatile sector in the market. When it comes to tech, as you also see, tech is right in the middle. Doesn't have a very huge say in this portfolio at about 9.8%. And speaking of its top 10 holdings, you're led with some high dividend payers such as AbbVie, Home Depot, and Altria. I actually invest in each of those 3 different stocks, and if you know anything about them, you'll know that they all each either have a high dividend growth history or currently have high dividend yields. Another thing that's really important about ETFs is their expense ratio, a fee you have to pay because the ETF is monitored by their respective company, and luckily SCHD's is very low. It sits currently at 0.06%, which means you're only getting charged $6 every year for every $10,000 you're investing into, which it's not much. Then we have VIG, which is your Vanguard Dividend Appreciation ETF. This tracks the S&P US Dividend Growers Index, which is basically just a series of stocks that have consistently grown and paid dividends for the past 10 years. This position has $112 billion in assets under management and 340 holdings, so it's even more diverse to a degree than SCHD. Let's just show you what its holdings look like. As you can see, it has a huge holding in technology, 27.6%, followed by financials and healthcare at 22.47 and 14.62%. And unlike SCHD, consumer cyclical is a little under halfway at 5.46%. So this is an ETF that is really focused on a lot of growth, but could also have a lot of volatility in the process, even in the negative direction. But anyways, speaking of its top holdings, you're looking at some insanely tech growth stocks, including Broadcom, Microsoft, and Apple. These are companies that have had some tremendous growth over the past 5 to 10 years. So if this is something you're looking forward to, then this should be a good sign. And speaking of other good signs, it also has a low expense ratio, actually just a little bit lower than SCHD at 0.05%, meaning you're only getting charged $5 a year for every $10,000 you're invested into. Now these are all great, but let's actually see how these two compete against each other using those 5 metrics that we love and see which one can be beneficial for your low budget. First, we have your earnings per share, which is just simply the net income divided by the number of outstanding shares. You'll notice throughout the video that a few of these metrics are company-based, and of course ETFs aren't companies, they're a basket, so SCHD and VIG don't have their own EPS. So what I did was I used the top 5 from each position, which I know isn't a huge portion of it, but each are at about 21% respectively, so just keep that in mind. So anyway, with SCHD, its ETF average for its earnings per share based off its top 5 is 7.81, led by Home Depot at 14.87, and then followed by CVX at 8.95. VIG, on the other hand, has an EPS average of 7.32, led by JP Morgan at 14.08, and followed by Microsoft at 9.2. And of course, when you compare the two, you'll see that SCHD's average earning per share is a little bit higher than VIG. So that just shows that SCHD has some stronger overall earnings consistency in comparison to VIG. But even though VIG's EPS for its top 5 are lower than SCHD, these top 5 are filled with companies that are consistently growing at a rapid rate, so its earnings could compound over time and maybe end up being higher than SCHD's. Your next metric is your dividend yield, which is probably the first thing that we're all looking at as dividend investors. And as you can see, SCHD currently has a dividend yield of 3.75%, paying about $1.03 per year per share. You can really see the effect of the type of companies under their umbrella when you look at their dividend CAGR, or the annual percentage growth of a dividend yield. You're looking at a little over 8% for its 3-year CAGR and almost 11% for its 5 and 10 year. VIG has a lower dividend yield at 1.63%, paying about $3.52 per year per share. Now, their low yield makes sense because growth stocks typically take that money and reinvest it back into themselves rather than give it to the shareholders as dividends. But even with that, having a 5 and 10 year dividend CAGR of 9.6 and 7.24% shows the rapid growth potential of their dividend on top of the share price growth potential. Next, we have total return, which is probably my favorite metric as a long-term growth investor because it tells you the full story of a stock or ETF's growth position, keeping in mind the share price growth and reinvesting the dividends it pays out. So when it comes to SCHD, its price return over the past 5 years is 45.49%, which is awesome. But if you reinvest those dividends that it pays out over that same period of time, your total return would be 73.45%. or about 28% more. VIG, on the other hand, has a higher price return at 68.04%, and its total return, assuming you reinvest their dividends, is 84.48%, or about a 16% jump. Comparing the two, SCHD is going to give you the biggest bump in returns if you reinvest their dividends. That makes sense because, again, the ETF is filled with positions that already have slightly higher dividend yields and are also healthy enough to maintain some dividend growth. VIG, on the other hand, already has an initial higher price return and is filled with positions that pay a good enough dividend to give it an even higher total return. And when you're investing into a basket of tech stocks that include Broadcom, Microsoft, and Apple, then, it definitely checks out. Next, we have the debt to free cash flow ratio. This is important because it basically tells you how many years it would take a company to pay off all of its debt just by using its free cash flow. A healthy range is going to be about 1 to 2 times. A moderate range is going to be about 3 to 4 times. And anything 5 or above is a little bit risky, but you have to keep in mind what the company's history looks like and what their financials look like despite their debt to free cash flow history. Now, using the yearly average of the top 5 positions in each ETF, SCHD actually has a combined 5-year average of 4.88 times, while VIG, on the other hand, is slightly higher, has a combined 5-year average of 7.26 times. So this just shows that SCHD's top 5 has a better financial history, that it can actually pay off all of its debt about 2 years faster than VIG could. But keep in mind, the companies in VIG, especially their top 5, have a history of carrying more debt while still being able to grow, which gives more emphasis on their higher growth rate. And our last metric is the payout ratio. This is the percentage of a company's income that goes to the shareholders in the form of dividends. Now, again, when you look at the top 5 of SCHD, you'll see the average payout ratio is 57.86%. And VIG, on the other hand, its average for its top 5 is 27.61%. Now, again, this further proves that SCHD is more of a dividend payer, so it's more beneficial for your income. And that's especially cool when you consider the fact that SCHD has been able to pay and increase their dividends for over the past 13 years. VIG, despite also being a dividend payer, shows that with its slightly lower PO ratio, that it actually takes more of its money and invests it back into itself, which means it can use that money to discover more things, more tech-related things, make some more expansions, anything that can result in the company making more revenue and ultimately for shareholders increasing its share price. It's also beneficial for dividend investors because it gives those companies a financial opportunity to increase their dividend payout if they choose to. So it's all great, but one thing that's important to me as a low budget investor is what could the small amount of money I have do for me if I invest into any position over the course of time? So as someone that invests $30 every single week, one thing I like to do is use trackyourdividends.com to see what a stock or ETF based off its past experiences could give me in dividends and overall share price value over the next 5, 10 to 20 years. Keep in mind, I'm using past values, and the past doesn't always determine what the future of a stock or ETF will be, but it gives you an idea of what you're getting yourself into. So keep that in mind. But regardless, this is what SCHD and VIG would look like if I invested $30 per week for the next 5, 10 to 20 years. With SCHD, after 5 years, I could start making $287 per year dividends, and my portfolio value would be about $8,739. If I invest for 10 years, my portfolio could start paying me $864 per year in dividends, and my ending value could be $29,023. And in 20 years, my portfolio could make me $3,809 per year in dividends, and the value could be about $155,617. And this is what VIG would do. You can probably assume how it would compare. After 5 years of investing into VIG, my portfolio would pay me $95 per year in dividends, but would have a projected balance of $9,417. 10 years of investing in VIG would result in me making $208 per year in dividends and having a projected balance of $35,173. Investing in VIG for 20 years would have a portfolio that would pay me $514 per year in dividends and a balance of a little over $250,000, which is insane. So as you can see, investing $30 per week into each position for 20 years would give you more dividend income with SCHD, but more overall projected balance value for VIG. So it really just depends on where you're at in life. But you may be somebody that wants to get a little bit of a hybrid and invest in both. So if you were to put $15 every single week into both positions and have that as your overall portfolio, within 20 years, your portfolio would start paying you $980 per year in dividends with an ending value of $180,940. That's really cool because it gives you more dividends within that time than VIG would, but a higher overall projected balance than SCHD would. These are both really great ETFs that can get you really far in life with a small budget, but it just really depends on where you're at in life, your comfort level, your age, and what your goals are now and upon retirement. But if you're someone that leans more towards the higher volatility but the opportunity to make more growth in like sectors like the tech sector, for example, make sure you check out this video where I talk about another ETF, SCHG, which has even more insane growth than an ETF like VIG. So hopefully you get some time to check that out. I appreciate you guys watching this video, and until next time, as always, take care.